Let's rip the band-aid off. The stock market will crash. It's not a question of if, but when. History tells us it's happened countless times before, and here's the kicker, it's going to happen again. But before you start stuffing cash under your mattress, let me tell you something surprising. A market crash doesn't have to be terrifying. In fact, if you're prepared, it can be an opportunity to thrive. I've been investing for quite some time, and during that period, I've ridden through more market crashes than I can count. And guess what? I've come out of each one wealthier than when I went in. Today, I'm here to share what I've learned, so you can navigate the chaos and come out ahead too. By understanding the signs of a crash and knowing how to act, you can turn what looks like disaster into your biggest financial win. Let's start with a question. How common are market crashes really? Turns out they're like bad reality TV shows, more frequent than you'd think. There are 3 types of market declines, and knowing the difference can help you prepare. First, the market correction. This is the most common type of decline and is defined as a drop of at least 10% from a recent high. Think of it like the market realizing it overindulged at an all-you-can-eat buffet and taking a breather. Since 1980, these have occurred about every 1.2 years. Next, the bear market. Now we're talking about something more serious, a decline of over 20%. These happen about once every 4.7 years and last an average of 9.6 months. That sounds rough, but remember, bull markets, when prices are climbing, tend to last 2.6 years on average. Finally, the stock market collapse. This is the big one. A drop of over 30%, often in a short time. These are rare, but when they hit hard. Imagine a scenario where a key political figure faces a sudden and extreme event. Markets can spiral into chaos. For example, remember when Trump had that close call with a bullet a few months back? If things had gone the other way, the market would have gone nuts. The lesson here? If you're not ready for the market to drop, you're not ready to invest. So how do you see a crash coming? It's not as mystical as reading tea leaves. There are patterns you can spot. Let's break it down into 3 phases and discuss what you can do at each stage. 1. The euphoria phase. The good times, when markets are sky high, and everyone is convinced the party will never end. This is when irrational exuberance takes over. Remember the NFT craze? People spent millions on JPEGs. When things like that happen, it's time to get cautious. Before the 2008 crash, I noticed 2 big warning signs, a spike in consumer spending and a boom in easy credit. Everyone was refinancing homes and splurging, thinking the good times would roll forever. Spoiler alert, they didn't. To prepare during this phase, I focus on reducing risk. I'm not chasing sky-high returns, I want consistent gains. Think of me as the tortoise in the tortoise and hare race. Avoiding leverage. Debt can magnify gains, but it can also ruin you. I've seen too many people go from millionaire to broke because of margin calls. Saving extra cash, I keep an emergency fund and stash even more in high-interest accounts. In 2008, this gave me the liquidity to jump on opportunities when others panicked. Diversifying spreading investments across sectors reduces risk. It's the don't put all your eggs in one basket approach. 2. The reckoning phase. This is where reality punches the market in the face. Overvaluations unravel, panic sets in, and people sell in droves. The key here is holding your nerve. If you believe in your investments, don't sell just because prices drop. Peter Lynch's story about Kaiser Industries is a great example. He held onto a stock that everyone else abandoned, and it eventually rebounded. I also take advantage of this phase by dollar cost averaging. Instead of trying to time the bottom, I invest steadily over time. Looking for bargains, crashes turn high-quality stocks into discounted opportunities. Staying diversified, again, this helps cushion the blow. 3. The Phoenix phase. Every crash is followed by a recovery. Markets rise from the ashes like a phoenix. After 2008, it took about 4 years for spending habits to normalize, but the recovery eventually came. This phase is when fortunes are made. If you've stayed the course, managed your risk, and bought wisely during the downturn, you'll be in a great position to benefit as the market rebounds. The stock market's ups and downs aren't something to fear, they're something to understand and prepare for. By sticking to sound strategies like risk management, diversification, and consistent investing, you can turn market turbulence into an opportunity. Want to make money so you can start investing? Then check out my 54 Side Hustles dossier. It's packed full of money-making ideas. I tested them all. I'm sure they can help you start making money this week. Download it below, and don't forget to subscribe. Let's grow your wealth together. See you in the next one. Oh, and if you've made it this far without panicking, congratulations. You're already better prepared than most investors.